Good morning everyone and welcome to another RF crypto video. Today's markets have picked up quite a lot by almost 6%. The global crypto market cap now stands at 1.85 trillion with Bitcoin going up 8.5%, Ethereum by 7%. The whole market is basically up. We see that looking at the top 50 coins, every single coin, barring Waves, is up. And Waves is down by almost 6%. This may be due to token-specific factors that have nothing to do with the general market, and that's why it's not following the market trend of price increase. Even looking further down, we see increases across the board, and the markets are doing quite well. And we're going to speak about why quite soon. So the markets were trading laterally for a couple of days. If you can see, it was trading from the 5th of March until the 8th of March between the band of 38,000 to 40,000, sometimes going below the $38,000 support level but getting quickly bought up. But this time, the price has shot up above the $40,000 resistance level, and it just kept going up and up and up, and it broke the new resistance level of around $42,000. Now it rests to see whether it's going to keep going up to the $45,000 resistance level, or will it trade between 40,000 and 42,000. So it is a matter of a fight between the bulls and the bears to see who wins, but at the moment you can see that the bulls are winning. And this is a good sign for general market because it's seen a gradual decline from 45,000 to around 37,000, and now it's seeing most of the losses getting recouped and the price might be heading back to where it was at the beginning of the month. Why did Bitcoin go up so much, and why is it standing at $42,000 while yesterday it was sitting around 38,000? Well, it's because Janet Yellen's crypto statement inadvertently was published early. So Bitcoin rallied on Wednesday, pushing the broader crypto market higher after US Treasury Secretary Janet Yellen's inadvertently published remarks revealed that President Joe Biden's impending crypto order would take a constructive approach in regulating the digital asset industry. A presidential executive order on cryptocurrencies would support reasonable innovation. Under the executive order, Treasury will partner with interagency colleagues to produce a report on the future of money and payment systems. And this is an extremely good sign, and it's a bullish sign for the market because they're not setting to restrict people from trading in crypto. They're not looking to restrict companies from developing crypto products or just limiting the development of blockchain in general. What they want to do, they want to regulate it, but in a constructive approach, in the sense that to prevent chaos and to prevent fraud and money laundering. Obviously, they'll want to regulate the sector, but they won't regulate it so far as to hamper innovation. It's going to regulate it in a way that will support innovation. And this is an extremely bullish sentiment, and this is what led to the price of Bitcoin and the general crypto market to shoot up by as much as it did today. However, while Yellen's comments have revealed a balanced approach to regulating crypto, concerns about crypto's use for illicit financing persists. The executive order will address risks related to illicit finance, protecting customers and investors, and preventing threats to the financial system and broader economy. And this makes perfect sense because there is no economy in the world, or there is no government in the world that wants a financial product to be used for illicit financing, for money laundering, fraud, corruption, terrorist financing. An unregulated sector, it is easy to do that. But when something is regulated, it becomes extremely hard to do that, especially in an advanced economy with all these controls, such as the United States. And this is the approach that they want to bring in order to cut down on the money laundering that obviously, as much as we don't want to accept it, takes place with cryptocurrencies. And this will lead to a homologation of the whole crypto and blockchain industry in a way that it can grow. Maybe it won't grow as fast as it did before, but it will grow at an extremely rapid pace, but in a controlled, concise, and regulated manner, such that no one gets duped. Listing of coins can't be done willy-nilly. They have to have a use case. They just can't be meme coins anymore. And that's a good thing because meme coins are mostly rug pulls where the founders of these meme coins trick retail investors into investing, and then they pull the rug and the price goes to zero. They run away with their money and you lose all your money. So in order to prevent this, they want to regulate crypto in a way that helps both the government in terms of tax collection, fraud prevention, and money laundering, as well as help the retail trader not fall into these traps, have a more seamless experience in terms of trading. And also, I think with regulation, they will have a lot of support programs for up and coming blockchain companies that want to make it. And a lot of innovation is still going to take place in this industry. And the fact that regulation is not going to hamper it, but going to support it, is a good sign for the crypto market in general. And that was reflected in the increase in the price of Bitcoin and all the other tokens in the markets today. On other news, Ethereum transaction fees dropped to 6-month lows. So in its most recent report, Arcane pulls Coinmetric data to show that the 7-day average for Ethereum transaction fees are at their lowest since August of last year. Obviously, they've been heading down very quickly since the second week of January. They say that if you have been waiting for lower fees before swapping tokens or minting NFTs, now might be a good time. And this is because the gas fees are ridiculously low compared to before. Obviously, they're not cheap. They're still expensive. The cost of a token swap is $15. This is still very, very high compared to Solana's cents. But that's still below the $200 that you would have to pay for a token swap during much of the fall of 2021. Perhaps unsurprisingly, the drop in fees coincides with the fall in crypto asset prices. The exchange value of Ethereum has declined nearly 12% in the last week and almost 15% in the last month. And as usual, as Ethereum becomes cheaper or worth less, transaction fees obviously become cheaper in dollar terms because of less activity in the network as well. If the network is less congested, then transaction fees will get lower. And the main consensus for why the transaction fees or the gas fees have decreased is a lull in interest in NFTs, the blockchain-backed contracts tied to digital or real-world assets. These NFTs, which often come in the form of digital art or collectibles, originated on Ethereum network and caught fire last year. I think almost 80% or 90% of all NFT minting and swaps in the marketplaces take place on the Ethereum network. And their popularity translated into increased traffic on the network, which manages supply and demand by calculating the computing costs for each transaction, token swap, auction bid, or what you have and passing that along to the user in the form of a gas fee. So the higher the number of transactions, the more congested the Ethereum network will get, and the higher the gas fee that you'll have to pay. So because the interest in NFTs have gone low or they've decreased, we have seen the number of transactions also decrease. And because of that, the gas fees decreased as well due to less congestion. VanEck is launching crypto mining EFT. So VanEck's Digital Assets Mining EFT, or the DAM, opened for business on Wednesday, offering targeted exposure to those companies in the crypto mining industry. The exchange-traded fund will invest at least 80% of its total assets in securities of crypto miners that generate or have the potential to earn at least 50% of their revenue from mining activities or related technologies. And I think this makes perfect sense because this is a growing industry. Mining is only getting traction. Mining is becoming greener. Mining is becoming more attractive to governments, which are offering incentives for miners to move to their countries and run their businesses there. So it is a fact that having an exchange-traded fund that offers exposure to mining companies is a clever move because the interest in mining and the demand of mining is only increasing, not only for Bitcoin, but also for other coins as well. And as they say here, the crypto mining sector is still in its early stages of growth, and high levels of demand from investors for all type of digital assets are going to increase, and that will also increase the demand for mining. VanEck, if you recall, also has a futures-based Bitcoin ETF product it launched in mid-November, so the Bitcoin Strategy ETF, as well as a digital transformation ETF. The company also tried to get a spot Bitcoin ETF approved, but it was rejected by the SEC, or the Securities and Exchange Commission of the United States. But with all of these ETFs coming out, especially with futures and mining, we will see a spot Bitcoin ETF soon. So Elizabeth Warren is drafting a bill to track transactions of private crypto wallets. This comes because the US and its allies have cut off the Russian central bank from hundreds of billions in foreign reserves. They've removed Russian banks from the SWIFT communications network, and financial transactions between the West and Russian state actors are banned. However, some US lawmakers are still concerned that Bitcoin and other cryptos can be used to bypass sanctions if the crypto industry isn't on board. One of these senators are Elizabeth Warren, who says that they're drafting a new bill to ensure that crypto isn't used by these sanctioned Russians to undermine, obviously, the economic sanctions imposed by the United States and the West. How would they do this? They would want to make it easier to verify the identities of customers in transfers to private crypto wallets by requiring financial institutions to keep detailed records and submit reports to the Treasury Department. And they're going to put a lot more pressure on these exchanges such as Binance and FTX so that they ban trading from sanctioned Russians, and also to keep track of every single transaction, where it's coming from and where it's going, in terms of the identity of these senders and receivers, just to make sure that none of the sanctioned Russians are using cryptocurrencies to try and evade the sanctions. This is going to be very, very interesting in the next few weeks because, as I said before, crypto is playing a big part in the Russia-Ukraine conflict. And again, one more bill is going to be proposed for crypto relating to the conflict. And that's it for today's video. Thank you very much for watching. If you liked the video, please consider leaving a like, hitting the subscribe button, and sharing this video with your friends and family. I'll see you tomorrow for the next one. Invest wisely, and cheers.